Okay, student, today we are going to work on a comprehensive problem from chapter number 3. And in this problem, we are going to study adjusting entries. So in the previous lecture, we have discussed how to make a trial balance. And we came up with a very nice trial balance that was all debits was equal to all credits. But in real life, as I said in the previous lecture, it does not happen. It almost never happen 99.99% of the time. Why? Because there are so many adjustments accountants have to do every period, because a business is a continuous process. And when an accountant tries to make a financial statements, and as we talked about, trial balance is a precursor to the financial statements such as balance sheet and income statement, a statement of retained earnings, and a statement of cash flow. We have to calculate the expenses and the revenue that we have to match for the period. And the period, as we discussed in chapter number 1, it could be a 1 month, it could be 3 months, it could be 6 months, or it could be a year. In this question, we are closing for the whole year, so it's the period here is 1 year in this question. Another thing that we have learned in the past 3 chapters is that the revenue recognition and expense recognition principles. The revenue recognition principle dictates that we have to recognize the revenue in the period in which it is earned, and expense recognition principle simply says that we have to recognize all the expenses that has been incurred during the year. So once we match the revenues and the expenses, then we come up with a net income. So as the simple formula for net income is revenue minus expense. So we want to know how much revenue a business has generated during the period, and in this case during the year, and how much expenses we have incurred in this period. So when we subtract it, we get the net income for the year. So to get the idea. But as I said, business is a continuous process. A lot of things fall or overlap between 2 years or between 2 periods. So we are going to find out how we close the month. And closing the month or closing a quarter or closing the year is a part of almost every accountant, especially if they are working in financial reporting or in making financial statements. So making financial statements, financial reporting is a part of it. So this is what we're going to do. So this is the background of this question. I hope you have already watched the lectures that is provided by the author of this textbooks, and this lecture is going to supplement what you have learned in those lectures, and by reading the textbook and by reading the lecture notes and PowerPoint. So let's start, see what this question is all about. So in this question, they are asking journalizing, adjusting entries, and subsequent journal entries. So we're going to talk about these journal entries. So there is a company named Laughter Landscaping has collected the following data for December 31st adjusting entries. So each Friday, Laughter pays employees for the current week's work. The amount of the weekly payroll is $8,000 for 5 days. That 5 days means Monday through Friday work week. This year, December 31st falls on Tuesday. Laughter paid its employees on January 3rd. So we have December 31st here on Tuesday, and the Wednesday, Thursday, and Friday. So it's January 1, January 2, and January 3. So we have to close our year on the Tuesday. So we will be paying them on Friday. So that means employees has already worked on 2 days, the Monday and Tuesday. Monday is December 30th, and Tuesday, which is December 31st. So employees has already earned these 2 days of salary, but they have not been paid. So that means the business owe them these 2 days worth of salary. So it's a salary expense and also a salary payable for these 2 days. All right, let's discuss on what's happening on the second part. On January 1st of the current year, Laughter purchased an insurance policy that covers 2 years. So that means January 1 of this year. So we have already used, so we are standing on, so we purchase on 1/1. Today is December 31st. So that means half of the policy has already been used. So once something that is prepaid, an asset has been used, is become an expense. So $4,000 will go towards the insurance expense, and the rest of the $4,000 we still have as a prepaid asset that will be consumed over the next year. In part C, the beginning balance of supplies was 4,300. We purchased another 5,600, and at December we have 1,500. So we want to know how much we have used because we know how much is left over. All right. So this is just explaining, what the question is asking, and then we will solve it together. In part D, it says during December, Laughter designed a landscape plan and the client prepaid $6,500. So client has given you the cash in advance. So in advance cash, as we discussed in the previous lecture, it's an unearned revenue. Laughter record the amount as unearned revenue. The job will take several months to complete, and Laughter estimates that the company has earned 40% of the total revenue. So that means 40% of the $6,500 we have earned. So that will go into a revenue, and the remaining balance will remain as unearned revenue as a liability until we complete the project. In part E, at December 31st, Laughter has earned $3,000 from landscaping services completed for turnkey appliances. So that means they have a project for turnkey appliances that they have completed, and they have earned $3,000 as a revenue. Turnkey has stated it will pay Laughter on January 10th, and they say they will pay the business on January 10th, but the revenue belongs to this year, not next year, even though they are getting paid in next year. So we have an account receivable, a claim on customer worth $3,000. So we have to take this into consideration when we are closing. This will impact our income statement as well as the balance sheet. The balance sheet will get account receivable for $3,000, and the income statement will get $3,000 of additional revenue. F, depreciation of the current year includes equipment 3,000 and trucks 2,200. So we have two depreciation expenses at the end of the year. These are expenses, yes. So these expenses will go to the income statement. So we need to make sure these two expenses will be generalized, recorded, and show up on the income statement. Laughter has incurred $250 of interest expense on a $550 interest payment due on January 15. So we have incurred $250 of interest expense, and we will make the payment. So we have interest expense and interest payable of $250 as of December 31st. Sorry. Now we read the requirement for this question. The requirement is journalize the adjusting entry recorded on December 31st for each of the following previous items affecting Laughter Landscaping, assuming Laughter records adjusting entries only at the end of the year. Some businesses do record adjusting entries on a monthly basis. Some businesses record these adjusting entries on a quarterly basis, like every 3 months. And some do it twice a year, like every 6 months, and some businesses do at end of the year. There is no hard and fast rule. Business chooses to do it. If they choose to do it like once every month or once a year, that is totally acceptable, but they just have to keep doing it in that sequence. The second part is journalize the subsequent journal entries for adjusting entries A, D, and G. All right. So now we're going to discuss first this requirement. We're going back again on part A. It says each Friday, Laughter pays employees for the current work. and the amount of the week payroll is $8,000 for a five days. And worksheet this year, so a work weekend this year, the December 31st falls on Tuesday. So what we're going to do, we're going to tell you how to calculate this thing. So for part A, I am going to show you something here quickly. So this is our work week look like. It's Monday, Tuesday, Wednesday, Thursday, and Friday. And that Friday is our payday. Okay, so we pay. And this year, this Tuesday, we have December 31st. And this is December 30th. This is January 1st. And this is January 2nd. And this is January 3rd. So as I said, the business is a continuous process. Even though the end of the year is falling on Tuesday, the employees will show up and work on Wednesday, Thursday, and Friday and will receive the payday. So let's calculate how. So with the total, as we see this in this question, payroll is $8,000 for 5 days. So that means we have a payroll is equal to $8,000. We have 1, 2, 3, 4, 5 days. So we divide this by 5. And how much are we getting for dividing this? So here is my calculator. So we have $8,000 divided by 5. So every day our salary expense is $1,600. So it's a $1,600. So for this year, so this is our this year. And these 3 days belongs to next year. So this year, payroll expense is equal to $1,600. And how many days we have this year? 1 and 2. So we have $3,200. All right. So we have salary for this year for these 2 days, Monday and Friday. This year payroll expense for the last 2 days of the year. That is Monday and Tuesday. All right. So this is what we know, that out of this $8,000, $3,200 belongs to this year, and the remaining amount. So let's calculate this. We'll multiply by 2, which is 32 minus 8,000. So $4,800. If you want to know what is going next year, the $4,800 belongs to next year. All right. So these 3 days is $4,800, and this year is $3,200. And we are only concerned right now for these 2 days. All right, this year. All right, let's move to part B. In part B, they say on January 1st current year, Laughter purchased an insurance policy that covers 2 years, and it cost them $8,000 that they have already paid them. So in part B, on January 1st, purchased insurance for $8,000 that covers the entire this year and next year. So that means each year it will be $8,000 divided by 2 is $4,000. All right. So which means that this year insurance expense is $4,000. All right. and the rest of the remaining 4,000 will go to the next year. All right, let's talk about part C. Laughter Madison, the beginning balance of office supplies was $4,300. All right, let's discuss this. Part C, office supplies, as we remember from previous chapter, an asset. Okay, it has a beginning balance. So the beginning balance is 4,300. So beginning balance is 4,300, and then during the year, Laughter purchased office supplies of 5,600. Purchase plus purchase office supplies is $5,600. So we're going to add these two, which equals to office supplies available to be used, which equals to, so let's see how much. So $4,300 plus $5,600 is equal to $9,900. So that means we have $9,900, and we will see what other information do we have. And at December 31st, office supplies on hand is $1,500. So minus office supplies on hand, which is equal to $1,500. So how much we have used? So if we subtract 9,900 minus 1,500 is equal to 8,400. So this 8,400 is office supplies used. So when an asset has already been used, it's called an expense. So office supplies expense is equal to $8,400. So this is what we have to calculate here. Now let's move to the part D. So what they are talking about in part D. In part D, they are saying during December, Laughter designed a landscape plan and the client prepaid $6,500. So we received $6,500 in advance. Laughter recorded this amount as unearned revenue. How do we record unearned revenue? We always says debit cash for $6,500 and credit unearned revenue for $6,500. All right. So we have created an unearned revenue is a liability, as we have already learned in the previous lectures. So let's make a T account for unearned revenue. That's a debit on this side and credit on this side. So we have $6,500. Okay. Now they are saying further, Laughter recorded unearned revenue. The job will take several months to complete, mean this year and next year. And Laughter estimates the company has earned, say, 40% of the total revenue. 40% of this revenue. So revenue is 40% of unearned revenue. So 40% of 6,500 is equal to what? So this is 6,500 multiplied by 0.4 that gives you $2,600. So that means the revenue they have earned is $2,600. So when they earn the revenue, that's we are going to record debit, unearned revenue, $2,600, and credit revenue or service revenue, if you want to call it, is $2,600. So this will be reduced by this much. So our unearned revenue, so 2,600 minus 6,500. Oops, sorry, I made a mistake. So 6,500 minus 2,600 is equal to, let's do it again. It didn't record it well. So it's 6,500 minus 2,600. So we have left a balance of 3,900. So that will be earned next year. So this is a revenue for this year, and this will be earned during the next year. All right. So we learned how to do this. So we will go and make adjusting entry, and we'll show you in a little bit. So let's talk about what we have in part E. In part E, it says at December 31st, Laughter has earned $3,000 for landscaping services that has completed. For turnkey appliances, turnkey has stated will pay Laughter on January 10th. So what we have doing here, that by December 31st, we have already completed the project. But client will pay later on January 10th. So what does it mean? It simply means you have earned as a business a revenue. So what we're going to say, debit account receivable for $3,000. And we're going to credit a revenue or service revenue for $3,000. What does it show? It shows that we have an asset, account receivable, going to our balance sheet, and a revenue which is going to our income statement. And it tells us if we don't do that, our balance sheet will be short of $3,000 asset, and our income statement will be short of $3,000 revenue. So that's why we have to do this. All right, let's see what we have to do on part F. Depreciation for the current year includes equipment $3,000 and trucks $2,200. All right. In part F, we have to simply say is debit depreciation, and we hyphenated it is for equipment for $3,000, and depreciation for trucks is $2,200. So we're going to credit, what do we credit? Accumulated depreciation for total of $3,000 plus $2,200 equals $5,200. Now, as you know, accumulated depreciation goes to the balance sheet, and these two expenses goes to the income statement. If we do not report these expenses on our income statement, our net income will be higher. By adding these two expenses, it will bring the net income lower. But as we have discussed from chapter 1, 2, and 3, we have to match all the expenses with all the revenue that we have earned to satisfy the revenue recognition principle and expense recognition principle. The accumulated depreciation that we have discussed goes to the balance sheet and sits right next to equipment and truck, and it helps us calculate at the end of the year what is the book value, because the book value is total cost of the equipment or total cost of the truck minus the accumulated depreciation of equipment and truck. That help us let us know that at the end of the year what is the book value of our assets are. Okay, now let's move to part G. In part G, we are talking about Lofter incurred $250 of interest expense on an expense on a $550 interest payment due on January 15th. So we have incurred so far 250. So interest expense incurred this year is $250. So what we're going to say, we're going to say debit interest expense of $250 and credit interest payable of $250. So what's simply saying that we owe interest on this note payable for this year $250, and interest payable signifies it's a liability that we haven't paid it yet. So it will be paid on January 15. So when we paid it, we no longer owe them this money after January 15 if we make the payment. All right, so let's go back to the requirements one more time and see what do we have. They are asking us to journalize the adjusting entry needed on December 31st for each of the previous items affecting Lofter Landscaping. Assume Lofter records adjusting entries only at the end of the year, every year. All right, so we'll go to the first one, part A again. On part A, we discuss that our salary expense for this year is $3,200. So how are we going to record this? We're going to record this debit salaries expense of $3,200, and we're going to credit salary or salary payable for $3,200. That's all we have to do. Now we will go to part B. In part B, we have calculated that this year insurance expense is $4,000. So we're going to record this as well. So debit insurance expense for $4,000, and we're going to reduce the prepaid insurance for $4,000. So let me show you how it looks like. So on January 1st, the prepaid insurance and asset looks like this, $8,000. Now on December 31st, we have reduced it by 12/31. So we still have the ending balance as of December 31st. This is the ending balance. This is the insurance used during the year. All right. So this balance will be used, ending balance will be used next year. All right. Okay. Now let's move to part C. In part C, we calculated the office supplies. The beginning balance was 43. We purchased 5,600. Office supplies available to use for the year was 9,900. Office supplies on hand is 1,500. So we find out is 8,400. Let me show you another way of calculating it. So here is your office supplies account. T account. Here is the debit side and here is the credit side. So on 1/1 you have beginning balance was $4,300, and then you purchase throughout the year. So you purchase during the year purchased for $5,600. So office supplies, though this is, you add these two, and this is equals to office supplies available to use, which turns out to be $9,900. Okay. Now in this question, they gave you the ending balance. So December 31st, ending balance is $1,500. All right. So how much you used? You take the 9,900, you subtract the 1,500, and you turns out to be 8,400. So this is office supplies used. And next year, beginning this $1,500 will become the beginning balance of next year. Okay, so you use this method. If you choose, it's your call. You want to use this method this way, or you want to use it this way. It's totally up to you. Both are correct. So if we have to do a debit and credit, that will be would be done this way. So we're going to say debit office supplies expense 8,400, and credit office supplies the asset account. All right. So what we are seeing here, so office supplies is an asset. Office supplies used is an expense. So remember always, when an asset is used up, so when an asset is used up, so this is an asset that has been used up, means cannot be used again, cannot provide you future benefit, so it's become an expense. So this is an expense, and this was an asset, but the leftover $1,500, this is still an asset that will be used next year. Okay, let's move to part G. Sorry, that was part we just did. It was part C. Now we're moving to part D. In part D, we talked about the cash that they have received, and they label it as unearned revenue because they haven't provided. But now at December 31st, they believe that they have earned 40% of the revenue, and they have earned $2,600 revenue. So we've already done this, but I'm just going to write down here as one more sign: debit unearned revenue of $2,600, and credit revenue or service revenue of $2,600. And again, we discussed this here, that this part, this is a revenue you have earned. This is still a balance or ending balance of an unearned revenue. So this was the beginning balance, this is an ending balance, and this is the revenue you have earned. All right, so this is a revenue you have earned, $2,600. That reduces the ending balance to $3,900. This will be earned in the later part of the next year. All right, let's go to part E. In part E, we discuss that by December 31st, we have already completed a project, but client will pay on January 10th. So that means we have an account receivable or a claim on our client or customer for $3,000 that they promised to pay on January 10th. So as of December 31st, we have debit account receivable for $3,000, and we're going to credit revenue or service revenue for $3,000. Okay, again, this information is going to balance sheet, and this information is going to income statement. Let's talk about F. We have already done this, but I'm going to do it one more time. So that is one way of writing it: depreciation equipment, debit depreciation equipment for $3,000, debit depreciation trucks for $2,200, and accumulated depreciation for $5,200. You can make one transaction, one credit, or you can make two credits. I'm going to show you, I've already showed you one. I'm going to show you the second one. It totally depends about among accountants how they decided to write. They can do it one debit, and they can also do one credit, and debit depreciation trucks. And then we're going to credit to accumulated depreciation. I'm just writing as abbreviation for equipment for $3,000, and accumulated depreciation for trucks for $2,200. Now, which one is better, doing it the first way or the second? It is your choice, but there are a good number of accountants out there. They say that your work should be more elaborate, means it easier for the reader to read. As you probably know, that people switch jobs these days is very common. In the past, people used to work one job 40 years, 50 years, but now they choose to change. So I think the last time I checked, on average, people change their job in 3.5 years. So for example, you work as an accountant somewhere for 3.5 years, and you move to a different place, and somebody must be reading your work. So if you write more detailed work, it's easier for the person who's taking over your job to see this information and don't have to waste time figuring out what you have done. So this is a better example compared to this example. All right, let's go to part G. What do we have in part G? In part G, we says the Laughter has incurred $250 interest expense on $550 interest payment on January 15. So they have to make a $550 interest payment on next year, January 15. But this year interest out of this $250 belongs to this year. We have already made a journal entry over here, but I will just make it again, is that debit interest expense for $250, and since it has not been paid, so credit interest payable for $250. That's all you have to do. Now we will see, that was the requirement number one. So I think I should this one was the previous page, this one was, so that was requirement one, sorry. So that was, the whole thing was requirement number one. So requirement number one. So that was requirement number one on these two pages. I will provide you these pages as well. So now we will look for requirement number two. Now they are saying journalize the subsequent journal entries for adjusting entries for part A, part D, and part G. I believe we have already done this, but let's see what they are asking us to do in requirement number two as well. Okay, so this one, they are saying the journal entry, subsequent journal entries. So what does it mean by subsequent journal entries? The subsequent journal entries will be to record, for example, payment of salaries on January 3rd. So let's say what we will be doing. So this is requirement number 2, and they are asking specifically for to do for A and D. So first of all, let's do for A. In part A, we already know we're talking about this salary. So as you know, the Friday is a payday. The $3,200 belongs to previous year, and the $4,800 belongs to next year. So on January 3rd, when you make a payment, how the journal entry will look like. Look at this. So this is, now we are on January 3rd making a payment. So we're going to do debit, salary, expense, $4,800, and debit, salary, payable of $3,200, and we're going to credit cash of $800,000. So what we are saying, this salary expense of Wednesday, Thursday, and Friday belongs to this year, the year that has started on Wednesday, January 1st. All right, and this $3,200 payable is coming from the previous year that ended on Tuesday, but they are making the payment on, so they are making a distinction of the expense. So this expense of $3,200 belongs to previous year, and this $4,800 belongs to this year that has started on Wednesday. So this is Wednesday, Thursday, Friday next year, or now it's a new year, and this one is coming from $3,200 from previous year. All right, now let's see what do we have in journal entry D. In journal entry D, we talked about an unearned revenue of $6,500, the money that they have received from the client, and they only provided 40% of the revenue, or they complete the project 40%. The 60% will be completed in the next year. So previous year they have earned $2,600. So what is they going to earn? So suppose they have earned that remaining $3,900. So they will be doing the same thing, debit, unearned revenue, of $3,900, and they will credit revenue or service revenue for $3,900. So here I showed you have an ending balance of $3,900. So next year at some point, so you started an unearned revenue. This is the debit side, this is the credit side, and you start with $3,900. Now you have provided the service, say you completed this project on February 15, for example. So on February 15, so this is January 1st, you have a beginning balance of $3,900. On February 15, you provide the service. So this is gone. So you are done. You do not owe this client any more services because it's done. All right. Now, another part they're asking you to do is part G this time. Let's see what we did in part G. So in part G, we talked about that we have an interest that we have incurred this year is $250, and we make an interest payable for $250. But remember, this interest was part of $550 that you have to pay on January 15. So on January 15, what you're going to do, you're going to debit interest expense of $300, and you're going to debit this interest payable of $250 that you recorded on December 31st. All right, so you're going to debit interest payable of $250, and of course you will credit cash of $550. All right, please let me know if you have any question about any of these videos. I will be happy to answer your question. You can ask me these questions either during my office hours. As you know, Monday through Thursday we have office hours from 3:30 p.m. to 5 p.m. and also you can ask these questions via email if for any reason you cannot make it to the office hours. Also, please make sure that you are watching lecture videos from the authors as well. They are very elaborate lecture videos. I've also provided you lecture notes, and we have also provided you PowerPoint, and all of those things are part of your learning process. So I hope you will utilize it as much as possible for you. Thank you.